and welcome to today's deep dive into Malaysia's dynamic debt capital market at Islamic Finance TV. While the pace of activity is anticipated to moderate in 2025, primarily due to planned decrease in sovereign debt issuance, the underlying fundamentals paint a picture of stability and continued growth. The Malaysian government is actively working towards fiscal consolidation, aiming to bring the general government debt to GDP ratio down to 75% by 2026, a notable reduction from the 77% recorded in 2023. This commitment to lowering federal debt is a key driver in the expected slowdown of overall issuance. However, the financial landscape is expected to remain supportive. The current policy rate of 3% is likely to hold steady throughout 2025, providing a stable funding environment. Furthermore, Malaysian banks and corporations are expected to continue tapping the debt market as a means to diversify their funding sources. This ongoing activity will help to counterbalance the reduced government issuance. It's worth noting that Malaysia boasts a well-developed debt capital market, especially when compared to its emerging market peers. This robust market features a diverse array of both issuers and financial products. In 2024, the total size of Malaysia's debt capital market experienced significant expansion, growing by nearly 10% to reach a substantial $557 billion, equivalent to 129% of the nation's GDP. While overall issuance did see a decrease of almost 25% year-on-year, this aligns with the government's stated goals of debt reduction. Regionally, Malaysia's debt capital market holds a strong position, ranking third within Association of Southeast Asian Nations, or ASEAN, with a 19% market share. Notably, the vast majority, around 92%, of this debt is denominated in the local currency, the ringgit. The market is also witnessing significant growth in sustainable and responsible financing. The volume of ESG-linked debt reached $14 billion, with Islamic finance playing a dominant role, accounting for an impressive 91% of this segment. Further underscoring the depth and liquidity of Malaysia's debt market is the level of foreign participation. Non-resident holdings of domestic government bonds stood at a healthy 22.6% in the third quarter of 2024, indicating strong international investor confidence. Malaysia's Sukuk market continues to be a global leader, primarily driven by ringgit-denominated issuances from the government. In fact, Sukuk represents approximately 60% of Malaysia's total debt market and a substantial 65% of all US dollar-denominated Malaysian Sukuk outstanding. Looking ahead, recent regulatory developments are poised to further enhance market dynamism. Regulations issued by the central bank in 2024 now allow multilateral development banks and qualified non-resident development financial institutions to issue ringgit-denominated debt securities. This will provide ringgit financing to resident entities without needing prior approval. This strategic move is expected to boost market liquidity and attract a wider range of investors, particularly those seeking high-quality investment-grade securities. So, while Malaysia's debt capital market may see a slight deceleration in overall issuance this year, its strong foundations, diverse participant base, and forward-looking regulatory environment position it for continued stability and growth in the long run.